Most traders think risk management is just a number. 1% per trade, done, risk managed. It is not. That is just one rule out of a complete system. And if 1% is the only risk management rule you have, you are missing the part that actually keeps your accounts alive when things go wrong. I have been trading with prop firms for 8 years now. I have managed hundreds of funded accounts across multiple firms. And in this video, I'm going to show you the complete risk management I use, not just the position sizing rule, the whole thing. Before the session, during the session, how I stop myself, and how I think about risk across multiple accounts at the same time. This is the system that took me from blowing fund accounts I should have kept to building close to $2 million in prop firm payouts. Let me get into it. The first thing I want to address is the definition, because most traders have the wrong one. Risk management is not about how much you risk per trade. That is position sizing, and position sizing is one component of a risk management, but it is not the whole thing. Real risk management is a set of decisions you make before the pressure arrives that removes the need to make those decisions in the moment. Here's why that matters. When you are in a session and you have just taken 2 losses and the market is moving and there is another setup forming, you cannot trust the version of yourself that exists in that moment to make good decisions. That version of you is emotional. That version of you wants to recover the loss. That version of you will find a reason to take a trade that you really should not take. The only version of yourself you can trust is the version that sat down before the session with no positions open and no money at risk and wrote down exactly what you would do in every scenario. That is what a risk management system actually is. A set of rules written by your calm self to protect you from your emotional self. And every single rule in this system exists for that specific reason. Let me start with position sizing, because even though it is not the whole system, it is the foundation. Here's how I think about it on futures fund accounts, and this is different from what most people teach. I do not think in percentages first. I think in drawdown. Every fund account has a drawdown limit. That drawdown limit is the total amount of money available to me before the account is blown. My job is to divide that into a set number of trades so I know exactly how much each trade costs me if it loses. I divide my available drawdown into 8 trades. That is my unit of thinking. 8 trades, 8 chances to find the right move before the account is at risk. So on a $50,000 account with $2,000 of drawdown, that gives me $250 per trade as my standard risk. That is what I call a normal risk trade. A setup that meets my criteria, that I believe in, that I am executing with full process. But I also have a second sizing level. I call it high risk. That is $500 on the same account, double the standard size. And I only use that on setups when I have maximum confluence. Everything is aligned, the liquidity is clear, the structure supports it, and I have very high conviction. Most of my trades are usually normal risk. High risk trades are very rare, maybe 1 or 2 a week if that, because high risk does not mean careless. It means I have a specific reason to commit more to this particular trade. The reason I think in drawdown rather than percentage is that it keeps me connected to reality. I know at all times how many trades I have left before the account is in danger, and that awareness changes how I trade. It makes me more selective. It makes me more patient. It makes every trade feel like a real decision with real consequences attached to it. The second component is the daily loss limit, and this is the one that most traders either do not have or do not follow. My daily loss limit is simple: 2 losses, and that is it. Not a dollar amount, not a percentage, 2 losing trades, and the session is over. I close the platform. I come back tomorrow. I arrived at this specific rule through years of data from my own trading, and the pattern was impossible to ignore. The sessions that turned into disasters were almost never the results of one bad trade. They were the results of what happened after the second or third loss. The emotional spiral, the need to recover, the trading that happened in that specific state. 2 losses and I'm done. That rule does not care how good the next setup looks. It does not care that I feel like I can make it back. It does not care that there are 2 hours left in the session. 2 losses and the day is over. Here is why this protects you more than any dollar limit. A dollar limit requires you to keep track of a number while you are trading, which means you are thinking about money instead of setups. 2 losses is a completely different mental model. It is not about money. It is about the state. 2 losses tells me that today is just not my day, that the market is not aligned with what I am looking for, that continuing to trade is not discipline. It is just me being stubborn. There is a version of this rule I call the early warning. If I take 1 loss and the second setup does not look completely clean, I do not take it, because I know that if I take a mediocre second trade and it loses, I am done. So I either wait for something perfect after the first loss or I just call it early. That is the difference between a trade trader who survives rough patches and one who turns them into blown accounts. The third component is a session stop protocol. It's a separate one from the daily loss limit. The daily loss limit tells me when to stop based on results. The session stop protocol tells me when to stop based on conditions. There are three things that trigger an early stop for me regardless of whether I have taken any losses. The first one is 2 losses in a row, as I already described. The result itself is the signal. The second one is the feeling. There is a specific feeling that shows up in trading that every experienced trader knows. It is the feeling of needing to make something back, of looking at the charts and not being able to see clearly because your emotional state is filtering everything through the lens of the loss you just took. The moment I notice that feeling, not after I act on it, the moment I notice it, the session is over. The third one is market conditions. If I come into the session with a clear bias and the market is not doing what I expected and I just cannot find a clean setup after a reasonable amount of time, I do not force one. I close my platform and I come back the next day. Most traders think that sitting at the charts and waiting is discipline. And sometimes it is, but sometimes the most disciplined thing you can actually do is recognize that today is not giving you what you need and walk away before you make something up. The session stop protocol is about reading both the market and yourself in real time and having the honesty to act on what you actually see. The fourth component is portfolio risk. And this is the one that almost no risk management content ever covers because most educators only think about one account. But when you are managing multiple fund accounts, which you eventually will be if you are very serious about scaling, the risk framework changes completely. The question is no longer just how much do I risk on this trade. The question is how much of my total funded capital am I exposing to risk right now. Here is the rule that I follow. I never trade more than 1/3 of my fund accounts at any one time. The rest are either in payout lockup, waiting for their turn, or in the evaluation phase. This means that if I have, for example, 9 funded accounts, I am trading 3 of them at most. The other 6 are protected from whatever happens in that session. Why does this matter? Well, because bad runs happen, and when a bad run hits, it should only hit 1/3 of what I have built, not everything. Recovering from 1/3 of your portfolio taking damage is very possible, but recovering from everything taking damage at the same time is much harder and seems impossible. And trust me, I've done that. I've copy traded all my accounts and I had a bad run and I ended up losing all of them. The way I apply this now on futures specifically is through clusters. I grab accounts into clusters of 2 or 3 and trade them together, usually the same prop firm, same entry, same exit, same risk. When one cluster or one prop firm is trading, the others are not. When the trading cluster locks in a payout, I either let it sit or rotate to the next one. This system means I'm always protecting the majority of what I have built while still being active in the markets if there are opportunities. It means a bad week on one cluster does not erase the work of the other 2. And it means that I can take risk with confidence because I know exactly what I'm exposing and what I'm protecting. And usually when I have a payout locked in, that also brings more confidence to continue trading. So to bring all of this together, a complete risk management system has 5 layers. The right definition, rules made by your calm self to protect you from your emotional self, position sizing, divide your drawdown into 8 trades, normal risk and high risk based on conviction level, the daily loss limit, 2 losses and the session is over, no exceptions, the session stop protocol, results, feeling and market conditions all tell you when to actually stop, and portfolio risk. Never trade more than 1/3 of your accounts simultaneously. None of these rules are complicated. All of them are genuinely difficult to follow consistently when the pressure is on. But that is the whole point. The rules exist for the moments when following them is hard. Anyone can follow their rules when trading is going well. The system earns its value in the moments when everything in you wants to break it. 8 years of trading, close to, actually above $2 million at this point in payouts. This system is why the payouts are still coming in even now. Not because I'm a better trader than everyone else, because I have a system that prevents me from destroying what I built on the days when I am really not doing my best, especially now with the market conditions due to the war. That is what risk management actually is. Now, if you want to build this kind of system properly with accountability, real guidance, I have a mentorship program called the Prop Firm Blueprint for traders who are really ready to do this the right way. There is a link in the description if you want to apply. And if you are looking for a good prop firm, I recommend Hola Prime. They have CFD futures and crypto fund accounts, and they have a no payout denial policy with payouts under an hour. You can use the link in the description or code NFX for 30% off. Thank you guys for watching, and I'll see you in the next one.